Hello and welcome to another global macro update.
My man!
Going to start things off with a quick summary of some of the stories I'll be getting into today. So, Vice Chair Lael Brainard gave a speech on the Fed's economic outlook and monetary policy.
Yep!
China shut down dozens of cities and millions of citizens due to its COVID-0 policy.
Not crazy.
The ECB prepares for its next interest rate hike. The Japanese yen hit a fresh 24-year low. Russia says it will retaliate against the G7 oil price cap. And the Ethereum MERGE to proof of stake is coming in the next week or two. Alright, but before I get into those, let's go over a quick recap of last week. So, last week, Chair Powell said he's definitely raising rates and keeping them there. And markets tumbled.
And we say bye-bye!
President Biden issued a massive student loan forgiveness plan.
Come on, man!
European inflation numbers for August came in at 9.1% for headline and 4.3%, which was a record for core inflation.
God damn!
Oil took a huge dive on news around the Iraqi supply and general global growth concerns. Ukraine's food exports out of the Black Sea finally picked up.
Nice.
And Meta added more NFT functions to its platforms. Exactly. All right, but let's go ahead and jump into this week. Starting with Vice Chair Lael Brainard, who is the second in command after Powell, so pretty important, gave a speech on the Fed's economic outlook and current stance on monetary policy. So here is the written speech right here. I'm just going to go over some of the highlights. Over the past year, inflation has been very high in the United States and around the world. No shit. High inflation imposes costs on all households, and especially low-income households. With a series of inflationary supply shocks, it is especially important to guard against the risk that households and businesses could start to expect inflation to remain above 2% in the longer run. The Fed is constantly focused on managing expectations. In fact, I think there's actually a lot of stories I'm going to be going over today where central banks all over the world are kind of reiterating this. They really do focus mostly on expectations because they think if the public starts to believe inflation is going to get out of hand, then it will. And, you know, that might be true to a certain extent, but I think they place a little bit too much, or they emphasize expectations of the public a little bit too much.
Totally.
Anyway, I digress. So, the Federal Reserve is taking action to keep inflation expectations anchored and bring inflation back to 2% over time. While last year's rapid pace of economic growth was boosted by accommodative fiscal and monetary policy, as well as reopening, demand has moderated this year as those tailwinds have abated. Real spending on goods has declined modestly in each of the past 2 quarters, while real spending on services has expanded at about half its 2021 growth rate. Even so, the levels of goods spending remains 5% above the level implied by its pre-pandemic trend, while services spending remains 4% below its trend. This is one of the main themes that kind of emerged post-pandemic, or even kind of during this transition to a more goods-focused consumer base rather than service-focused. Obviously, you know, you can't really go out to restaurants during the pandemic, and that trend kind of stuck with people. You know, buy stuff on Amazon rather than going out to the bar or whatever it is. So that this trend right here is still kind of alive, even though it's starting to, I guess, retrace or come back to some sort of normal level. We still have level of goods remaining 5% above previous levels, and services spending remaining 4% below its trend, right?
Yep!
Okay, so core inflation, which is inflation excluding volatile food and energy prices, also moderated in July. Core goods PCE inflation decelerated to 0.1% month over month. Thank God. After averaging 0.5% in May and June, while the moderation in monthly inflation is welcome, it will be necessary to see several months of low monthly inflation readings to be confident that inflation is moving back down to 2%. Now, this is an important point because a lot of people, maybe not a lot, I don't know, at least some people are definitely assuming that as soon as inflation starts to show signs of a reversal, that the Fed is going to start pivoting or easing their policy, whatever it is. But they have said this multiple times, that they want to see a consistent trend, or at least 2, maybe 3 months of inflation abating, going the opposite direction before they start taking their foot off the gas brake, slowing, speeding up the economy, whatever metaphor you want to use. They will not take their foot off the gas, the brake, until inflation is showing serious signs of consistent reversal. So, I don't know exactly. It's anybody's guess. I would say 2 to 3 months at least of a reversing CPI PCE print.
Totally.
How long it takes to move inflation back down to 2% will depend on a combination of continued easing in supply constraints, slower demand growth, and lower markups against the backdrop of anchored expectations. Labor demand continues to exhibit considerable strength, which is hard to reconcile with the more downbeat tone of activity. I talk about this a lot, but the Fed uses employment numbers and labor more broadly to inform its policy decisions in a very meaningful way. When they see strong labor market, that usually, according to their models, that means that inflation is probably going to persist. Because if you have a tight labor market, there's more people maybe spending in the economy. But just in general, they want to see job growth. It's kind of a depressing thing. They want to see unemployment rise, because that shows them that their policy is working, right? So they want you out of a job.
Not crazy.
So the current high level of job openings relative to job seekers remains close to the largest in post-war history, consistent with a tight labor market. One of the stories I talked about last week touched on this, saying that the job openings are, I think there's a 2-to-1 ratio between job openings and people seeking jobs. So a lot more openings than a lot more openings than available workers. So as we follow through on our plan to move monetary policy to an appropriately restrictive stance, the effect of the increased policy rate and pace of balance sheet shrinkage, quantitative tightening, should put downward pressure on aggregate demand, particularly in interest-sensitive sectors like housing. Housing is definitely interest rate sensitive just because it's so leveraged. When mortgage rates go up, which is what they're kind of referring to, when they raise their rate, it naturally affects every interest rate in the economy is pretty much a derivative of the Fed funds rate, or the risk-free rate. So when the Fed raises its target rate, that affects mortgage rates. I think mortgage rates have actually gone up to close to 6% already. From several months ago, they were like 3%. So basically a doubling of that interest rate, which means people cannot afford the same house as they used to. And housing is such a big market. Aside from all the materials that go into building it, when you buy a home, you spend all this money to furnish it and all this other stuff. So when housing goes up or down, it really is indicative of kind of the broader economy. So even though they may be kind of narrowing in, saying particularly focusing on the housing market, that really is a kind of barometer for the broader economic health. Right?
Totally.
Okay, moving on. It may take some time for the full effect of these tighter financial conditions to work their way through the economy. If history is any guide, it is important to avoid the risk of pulling back too soon. In Powell's speech last week at the Jackson Hole Symposium, he talked about this when he was referencing Volcker in the 70s, how they kind of dealt with this a little bit. They basically pivoted a little bit, and inflation came back with a vengeance, and so they had to raise rates again, and they referenced that, basically saying that we're not going to make that same mistake. Which, in other words, means that they are going to keep rates, or at least this is what they're saying. Obviously, take everything with a grain of salt. This is what they're saying. They're going to move interest rates to restrictive territory and keep them there for an extended period of time to make sure that they slay the inflation dragon. And who knows if that realistically, it's probably going to break something in the economy. That's kind of what their goal is. But they are being very, very firm in their resolve, saying they will not flinch, they will not pivot. And that was kind of the summary of Powell's speech last week. In just a couple words, we will not pivot.
That was easy.
So we must maintain a risk management posture to defend the inflation expectations anchor. Again, back to anchoring inflation expectations. Really underscoring that. They always are all about expectations. Part of why they are maintaining this very strict resolve, because they want everybody, you, me, everyone else in the market to think that they are tackling inflation. Because if we think they are, then it probably will. It's kind of like a self-fulfilling prophecy. That's how they view it. Whether or not that's true or not, who knows? So while we have no control over the supply shocks to food, energy, labor, or semiconductors, we have both the capacity and the responsibility to maintain anchored inflation expectations and price stability. And then this is the final paragraph, really summarizes the majority of this. We are in this for as long as it takes to get inflation down. So far, we have expeditiously raised the policy rate to the peak of the previous cycle, and the policy rate will need to rise further. As of this month, the maximum monthly reduction in the balance sheet will be nearly double the level of the previous cycle. So they are going to be doubling the quantitative easing, which I don't think they're actually outright selling securities on their balance sheet. I'm pretty sure they just are letting them run off. Maybe they will be selling them. If they are selling them, that is definitely big news, because that will put a lot of pressure on the bond market. And that is not good for, if you hold bonds, probably going to see them devalue even more than they already have. But either way, they are going to be withdrawing liquidity from the market at an expedited pace. So that is something to keep an eye on in the coming weeks, months, as that actually starts becoming a reality. So continuing on, together, the increase in the policy rate and the reduction in the balance sheet should help bring demand into alignment with supply. Monetary policy will need to be restrictive for some time to provide confidence that inflation is moving down to target. The economic environment is highly uncertain, and the path of policy will be data dependent. Another crucial point, they've stressed this before, but I'll mention it again, the data dependent. And this is why anytime a new jobs report or, what have you comes out, the market reacts a little bit more, aggressively, because if the Fed is data dependent, every new piece of data is potentially a sign that they will go one direction or the other. So if it's good news or bad news, the market will react to whatever that, meaningful report is. Obviously, not anything, every report doesn't matter, but if it has to do with jobs or the ISM manufacturing or something like that, then the market will be watching that closely and probably react aggressively to that. Right?
Yeah.
So while the precise course of action will depend on the evolution of the outlook, I am confident we will achieve a return to 2% inflation. Our resolve is firm, our goals are clear, and our tools are up to the task. So they're really trying to kind of peacock and just show off that they are ready to do what it takes. Now, who knows? I feel like this is a different environment than the 70s. They can't really afford to raise rates all that high with the levels of debt right now. So they may be acting tough, but they in no way could ever raise rates to a real rate, because inflation's at, a little over 8% right now. If they wanted to raise, get real rates, real interest rates, not negative, they'd have to raise their policy rate to 9% or 10%, and that would just absolutely devastate the economy given how much debt we have. But anyway, still, not really that much new information, kind of just a reiteration of a lot of the stuff Powell was saying, but it's still important to follow, because a lot of times when they have these new meetings like this one, in between major ones, which usually means a Powell speech, they will walk back certain things, or if the market misinterpreted Powell, they will get extra hawkish in their next meeting, whatever it is. So that's why I like to look at these speeches from the other Fed chairs, because they will walk back or kind of adjust how the market interpreted previous speeches or whatever it is. But anyway, I digress. Moving on. So, next story. So this next story I got up for you is U.S. private payrolls growth slows in August. Now this is different from a lot of the other, I'll get into it, a lot of the public payroll reports that are kind of showing the opposite effect of a still strengthening or at least sturdy job market. But this is still important just because it's, private payrolls do matter, even though it's not like a broader government issued report. So U.S. private payrolls increased moderately in August, according to the ADP National Employment Report, which likely exaggerates the slowdown in the labor market as government data continues to point to strong demand for workers and very tight conditions. So like I said, a little bit conflicting data between government reports and this private payroll report, but still, so again, take it with a grain of salt or whatever. Private employment rose by 132,000 jobs in August after increasing 268,000 in July. Our data suggests a shift toward a more conservative pace of hiring, possibly as companies try to decipher the economy's conflicting signals. We could be at an inflection point from supercharged job gains to something more normal. Government data on Tuesday showed that there were 11.2 million job openings on the last business day of July, with 2 openings for every unemployed person. That 2-to-1 ratio I was talking about. Anyway, despite the Federal Reserve's rapid pace of interest rate increases to quell inflation, there have been no widespread layoffs, with weekly jobless claims still at considerably low levels. The ADP described the new report as an independent indicator and complementary to government data and not considered a forecast of the BLS private payroll number. So separate and apart from the government data, and they're kind of stressing that here, that this is, I'm not exactly sure about the methodology or if it really is just because it's focusing on the private payroll. Not really sure why they're qualifying it so much with this, but still, I guess it's important to know that this isn't exactly indicative of potential BLS reports like non-farm payroll.
Yep.
So the new series paints a markedly different picture of employment than both the official household and establishment surveys. I don't think the ADP numbers tell us too much about the upcoming jobs report on Friday. However, both reports are supporting the same narrative. The labor market is slowing as businesses cut back on hiring during this uncertain period of slow growth and high inflation. All right. So, next story. So, the next story I have is about the ISM Services PMI that came out a couple days ago or earlier this week. I think it was Monday, and it was unexpectedly higher in August. So before I get into this, I've talked about this before, but for anyone who doesn't know what the ISM reports are, they have services and manufacturing. This one is non-manufacturing, which is just another way of saying services. So let me explain what it is, and then we can talk about what actually happened this week. So the non-manufacturing ISM report on business is based on data compiled from purchasing and supply executives nationwide. Survey responses reflect the change, if any, in the current month compared to the previous month. For each of the indicators measured, business activity, new orders, backlog of orders, new export orders, inventory change, inventory sentiment, imports, prices, employment, and supplier deliveries. It's a mouthful.
That's what she said.
This report shows the percentage reporting each response. An index reading above 50% indicates that the non-manufacturing economy in that index is generally expanding. Below 50% indicates that it is generally declining. So that is the key part to focus on. This is really just a metric for measuring the, the expansion or level of expansion or in contraction of the economy, specifically in non-manufacturing or the service sector. So now that we have that backdrop, let me go ahead and explain the data that came in. So ISM Services PMI unexpectedly edged higher to 56.9, so above 50, positive territory, in August 2022 from 56.7 in July, beating market forecasts of 55.1. So it was a decent beat, and pointing to the strongest growth in services activity in 4 months.
God damn!
That being said, if you look at this chart right here, for those who are watching, strongest in 4 months, but you can tell that it is really not, relatively speaking, that strong. I guess this was kind of emerging from the pandemic, but we've had prints well over the 60, nearly 70 before. It's just the last few months have been really, really muted. What is this one? This one I think was 50, 55, and then we had a 56 like last month, and now this one that just barely edged higher. So even though that statement kind of makes it sound like it's a super big deal, it isn't as big of a deal as it might sound.
Yep.
So where was I? So business activity. So they have individual numbers broken down for all these sectors, so you can get an idea of how, because the 56.9 is the headline number, just kind of like inflation maybe comes in at 9.1. You have to decipher go into the different elements of it, like food, blah, blah, blah. So business activity was 60.9 versus 59.9, and new orders 61.8 versus 59.9. So both of those expanded faster. We also had employment 50.2 versus 49.1. Rebounded despite a restricted labor market. And then we had, so based on comments from business surveys committee respondents, there are some supply chain logistics and cost improvements. However, material shortages remain a challenge. So in general, this was actually a surprise to the market a little bit, and a lot of people were pointing to this as the reason that the market kind of crashed, or not crashed, but took a big dive at the start of the week post Labor Day. Because again, if the Fed is data dependent, like I was just talking about earlier with the previous story with Lael Brainard, then a report like this showing a stronger economy than expected would be a sign that the Fed has, more of a green light to raise rates even further. And that's why we saw bond yields rise and the market in general kind of dip.
And we say bye-bye.
All right. So next story, we're going to transition to foreign markets now. So starting with the China COVID-0 story. So Chinese cities rush to lockdown in show of loyalty to Xi Jinping, the president of China, his zero COVID strategy. So more than 70 Chinese cities have been placed under full or partial COVID lockdowns since late August.
Not crazy.
Impacting more than 300 million people, as local authorities rush to stamp out infections at all costs in the final countdown to leader Xi Jinping's expected third term. So 33 cities are currently under partial or full lockdowns. The sweeping restrictions that upend lives and businesses stand in stark contrast with the return to normal life in much of the world, where societies have mostly pivoted to living with the virus. Now, from my perspective, Xi's basically kind of painted himself in a corner by committing himself so hard to this COVID-0 policy. And it's, like I said, it kind of painted himself in a corner, and he has to keep committing to it. And it's really draconian just because you're locking down cities of millions and millions of people, like cities that are bigger than any city in the US. I mean, it's like dozens of millions, like 23 million. And it's absolutely insane what's going on over there. They will lock down the entire city, like putting barricades outside of apartment complexes or buildings just so you can't leave to go to, anywhere really. I think they leave like certain supermarkets open, but short of that, it's basically like straight up lockdown, like at the very beginning of COVID. So like I said, pretty draconian, and he's been continuing this policy, and a lot of people are other people like under his command, which obviously everybody's technically under his command, but they are maybe like bending the knee a little bit to appease him because he is leading into his third term, which I believe is unprecedented. I don't think anyone in modern history has had a term that long. So it is kind of historic in a lot of ways. And, he wants to show that his policy, his leadership is effective. And so he's got a lot of people kind of appeasing him for that reason, to kind of make sure that this goes as smoothly as possible. Like they don't want, to upset him by not, I guess, adhering to the COVID-0 policy enough, because then he'll be like, oh, well, you guys aren't doing it the right way, or whatever it is. But either way, pretty crazy stuff going on, a lot of political angles to it. But let me go ahead and continue with this. So Xi, a staunch advocate of the country's uncompromising zero COVID strategy, is poised to be anointed as the country's top leader for another 5 years as the 20th Party Congress, scheduled to start on October 16th. So that's probably going to be a potentially volatile day in China. So the ruling Communist Party has used the zero COVID strategy to argue that its political model is superior to Western democracies.
Little bitch.
And Xi has thrown his weight behind the policy. Earlier this year, a painful 2-month lockdown in Shanghai sparked a public backlash and crippled the economy, leading some to question the zero-tolerance approach. In response, Xi issued a strong warning against critics, vowing to resolutely fight against any words and acts that distort, doubt, or deny his zero-COVID policy. Has a little bit of an ego, I would imagine. Don't all our leaders?
Yep.
So officials across the country have taken note. The main lesson they learned from Shanghai is to act more decisively and immediately when facing even the smallest of potential outbreaks. I believe there was one story of they shut down a city of millions and millions of people for like 8 cases. I mean, it's ridiculous. They literally have a COVID zero policy. Like, that is not an exaggeration. They see a single case and they'll shut down a city of 1 million people like that. It's absolutely wild. So for local officials, doubling down on zero COVID is a way to toe the party line, demonstrate their loyalty to Xi, and prevent any large-scale outbreak that could jeopardize their career weeks before the party congress. This provides a strong incentive for them to undertake heavy-handed, extreme preemptive measures. In the coming month and a half, we're going to see more cities under lockdown. So leading up to October 16th, when that, election or final term would come to fruition for Xi, we're probably going to see more of this, or at least a continuation of what is already implemented, because they want to, like this says right here, toe the party line leading up to that point to protect their careers, because Xi is obviously a very powerful man and he can throw that weight around. All right, so next story. All right, next up, we got the ECB poised for its next rate hike. So after raising interest rates for the first time in over a decade at their last meeting, European central bank policymakers are poised to deliver another bumper hike. I don't know who writes this stuff.
You're a fucking idiot.
On Thursday, in a show of determination to tame soaring inflation. So the previous interest rate hike was, I think, 50 basis points, and people are speculating that it's going to be a 75 basis point increase. Obviously, anybody's guess. I believe that's what the market's pricing in right now. So Eurozone inflation hit 9.1% in August, a record in the history of the single currency and well above the 2% rate targeted by the ECB. I think we all know that. So the only question for the ECB's meeting was whether it will be a 50 or a 75 basis point hike. Speaking at the annual Jackson Hole Central Banking Symposium at the end of August, ECB board member Isabel Schnabel, I don't know what that name is, said the ECB needed to show determination to tame price rises. Under this approach, the central bank would respond more forcefully to the current bout of inflation, even at the risk of lower growth and higher unemployment. Now, they're kind of they can raise rates, but they're also in the process of implementing this easing policy, the way they're backstopping certain government bonds like Italian bonds. I mean, they are selling German bonds or letting them run off their balance sheet and then reinvesting that principal or those whatever that runoff value and reinvesting those into Italian bonds. So basically selling German bonds to buy Italian bonds as a quasi form of quantitative easing to uphold or to backstop the riskier countries and their interest rates, because as the ECB raises interest rates, they're putting more pressure, relatively speaking, on countries like Italy, Spain, Portugal, Greece. And so I find it just ironic that they are, they're trying to act like they're very hawkish while they literally, after they raised rates to, it was 0% because they were negative. They raised rates to 0% amid 9% inflation, and they were already implementing this easing policy. So if you ask me, they've already pivoted. But, anyway, I digress. So, speaking, I already mentioned that one. So, under this approach, the central bank would respond more forcefully to the current bout of inflation. I already said that. So, the ECB's 25-member governing council surprised with a 50 basis point hike at its last meeting in July, bringing the end to 8 years of negative interest rates in one fell swoop. So keep that in mind. They were negative. They are still only at 0%. So hardly tackling inflation, if you ask me. So the door has been opened for the ECB to follow in the footsteps of the U.S. Federal Reserve and raise rates by 75 basis points. Following August's red-hot inflation numbers, the influential head of the German central bank said the ECB needed a strong rise in interest rates in September. Of course, Germany, which is one of the healthier economies, they prefer the rates to rise because they can handle that. They can weather that storm a little bit better than the other countries, and they would much prefer inflation to be quelled. But the ECB's chief economist, Philip Lane, has counseled colleagues to follow a steady pace of interest rate rises. Hiking at a rate that was neither too slow nor too fast was important due to the high uncertainty around the economy and the future path of inflation. Now, they're in a very complicated situation with the whole Russia, the war and energy crisis. So hard to say how they're going to, they could They have every reason to raise rates right now because of inflation, and they have every reason not to because of the dramatic impact of their economy and probably incredibly exacerbated growth slowing that's going to be hitting their economy in the coming months or even year. So, like I said, they have a reason to go either way with it, just because they're in such a difficult situation, really stuck between a rock and a hard place. So I still think they're going to be raising rates, but only because they feel like they need to save face, anchor expectations. So alongside its policy decisions, the ECB will also share an updated set of economic forecasts for the Eurozone. In its last estimates published in June, the ECB said it expected inflation to sit at 6.8% in 2022 before falling to 3.5% next year, while growth would slow from 2.8% this year to 2.1% in 2023.
Right.
But a more severe energy shock as Russia reduces gas deliveries to Europe could push the Eurozone into a deeper winter recession and hold growth to 0% in 2023. That'd be crazy. So the ECB had no choice but to commit to faster monetary tightening as long as inflation keeps rising, even as recession loomed. So we'll see what they do. Like I said, I'm pretty sure that the expectation right now is 75 basis points, though 50 is certainly in the cards. But I have to imagine that a more like a pivot. I mean, like I said, they already kind of pivoted with implementing this monetary easing through their anti-fragmentation policy by buying Italian bonds and selling German bonds. So in that sense, they've already kind of pivoted. But a real pivot of no longer raising interest rates has to be coming in the next few months. I just can't imagine them being able to weather this storm and continue raising, or at least raising at the pace that they're raising. They'll probably get back to quarter point raises and in no time.
Totally.
All right, next story. Okay, so UK also potentially, or not potentially, but they are going to be raising rates soon and potentially be doing so very fast and forcefully. So the Bank of England should be prepared to raise interest rates rapidly to reduce the likelihood that it will need to squeeze the economy for an extended period to bring down inflation. Bank of England policymaker Catherine Mann said on Monday. The gradual pace of increase in bank rate has not tempered expectations enough. Back to the expectations, right? I'm telling you, central banks are fixated on expectations because they think that's how they affect the economy. Their tools don't really affect the economy the way they want them to, and so their rhetoric is really the most powerful tool in their toolkit. A fast and forceful monetary tightening, potentially followed by a hold or reversal, is superior to the gradualist approach. So they are definitely siding with aggressive rate hikes, meaning most likely 75 basis points for this meeting or the upcoming meeting and potentially ones following that. Last month, the Bank of England said it was ready to act forcefully if needed who wrote this? Sometimes I think these Reuters people don't know English. They just forget so many words.
You're a fucking idiot.
After raising rates to 1.75% in its first half percentage point move since 1995. Financial markets currently price in an 85% chance that the Bank of England will raise rates by 75 basis points and what would be its biggest rate rise since 1989. So what we need to be doing is to ensure that the medium-term expectations don't continue to drift and become even more detached from the long-term anchor. The British public's expectations for inflation in 5 to 10 years' time rose to a record 4.8% in August. The Bank of England forecast last month that surging inflation, driven largely by rocketing natural gas prices since Russia's invasion of Ukraine, would cause a recession later this year. If current wholesale energy prices are allowed to be passed on to households and firms, this will lead to enormous pain for millions of people over the winter months. Liz Truss, which is the newly elected Prime Minister of England, just happened actually. So who was just says right here. So who was announced as winner of the Conservative Party's leadership contest earlier on Monday, has said she will announce tax cuts and some further support towards energy bills once she has been formally appointed Prime Minister. Of course, how else do you get elected other than promising handouts? All right, well, that is that. Yeah, so England right now, the UK, they are in a very difficult situation. I mean, their inflation was double digits. I think one of the only developed economies, like G7 economies, that had double-digit inflation. It was like 10.1%, which is absolutely wild. And they have forecasted that they're going to have serious economic downturn, recession. But they are also saying, like, listen, even though that is almost certainly going to happen, we are going to continue raising rates because we have to tackle inflation. But like I mentioned, a lot of the inflation has to do with them sanctioning Russia and cutting off all the energy that they got from Russia, among other things. I think total exports or imports from Russia dropped down 97%. So they only import just a small, I'm not even sure, it's probably like little stuff that doesn't really matter. But yeah, so I don't really know how raising interest rates is going to help that much. Again, this is back to them trying to manage expectations, because if you think inflation is going to go down, it might actually go down, because them raising rates is not going to do anything it's not going to create natural gas or create oil that suddenly lowers energy prices. So they're just trying to kill demand, temper expectations, and hopefully that gets the job done. But probably not going to happen. Anyway, transitioning. So this is a big story. Japan, or I guess the yen specifically, JPY, fell to its lowest level in like 24 years. And actually, so this story was from a couple days ago, like the start of the week basically, and it's up another, I think, like percent today. So it's just breaking a record every single day. It's pretty aggressive. I mean, the massive depreciation against the dollar has been unprecedented, especially because this is not a small currency. You know, we're not talking about like Zimbabwe's currency. This is Japan, which is arguably the third most important currency in the entire world, and is depreciated like 25% against the dollar. God damn! Crazy. So, Japanese finance minister, get ready for this, Shunichi Suzuki, on Tuesday reiterated that sharp yen moves were undesirable and that he was watching rising volatility in the exchange market with a great sense of urgency as the currency hit a fresh 24-year low. It was Suzuki's latest verbal warning on the currency, but it was not considered as strong as comments made in July, when a fall beyond 139 relative to the dollar prompted him to say he was concerned. The yen on Tuesday weakened beyond 141. I believe now it's 144, maybe even 145 per dollar for the first time since 1998. It has slumped nearly 20%. It's been moving so fast, this isn't even updated. It's at 25%, I believe, since the start of the year, largely because of diverging monetary policy between Japan and the United States. Because the United States is a lot more hawkish, they are raising interest rates, and Japan is still pinning their yields at 25 basis points. So that interest rate differential is driving more and more investors into the dollar. They sell yen, basically sell their government bonds to the Japanese government, get that yen, sell the yen, buy dollars, and this is why you're seeing this massive depreciation of yen relative to dollars.
Totally.
And for those who are watching, you can see this chart right here, pretty bare bones chart, but you get the idea of this is JPY or USD JPY. So, it didn't really start at the beginning of the year. There's kind of some consolidation, but ever since March, it has been on an absolute tear. So basically from March to today is when we've seen this 25% decrease relative to the dollar, which in a major currency is unheard of, absolutely unheard of. So while the Bank of Japan has vowed to stick to powerful monetary stimulus to back a fragile economy, the Federal Reserve is expected to continue raising rates for the time being, which again would put more pressure on the yen because of that interest rate differential further widening.
That's what she said.
So Suzuki said on Friday that Tokyo will take appropriate action as needed after the yen hit its lowest level in over 2 decades last week. Now, I don't really see how the Bank of Japan can really pivot. They have way too much. They are the most indebted country in the entire world. A lot of people don't really know that, but they have their debt to GDP ratio is like in excess of 300%.
God damn!
300%. Absolutely insane. So this is the reason why they're pinning their yields at 25 basis points. Because if, say, those yields go to 1%, that is 4 times as high. Which, for a lot of nations isn't that big of a deal. But for when you have 300% debt to GDP and you raise your interest rates even by like 1%, that means you are spending the yen is like in trillions, so trillions of yen just on interest payments alone. So as interest rates rise when you're that indebted, basically, I don't know what the exact percentage would be where this would happen, but it would be, I'm assuming, pretty low, where their entire GDP or income would be, like tax receipts, would be dedicated to paying interest. So that doesn't include any of the other expenses that a government needs to pay, like, entitlements, or just anything else, like all the stuff that taxes go towards, like all the public services and everything. So just the interest payments alone would consume the entire tax receipt income. And I don't know what level of interest rates that actually is going to happen, but if they're being forced to pin at 25 basis points, you can probably assume rates going to like 1% or 2% would do the job, which is, that's terrible, because they're basically boxed into a corner where they have to pin their yields at 25 basis points. Otherwise, they are going to have a complete, they maybe even default. They can't afford it. They're just going to print the yen into oblivion to, accommodate that problem, because there has to be a release valve in some way. And if you're pinning yields, then really the only release valve is your currency. And that's why the yen is depreciating dramatically, and why it's probably going to continue depreciating. Aww. So some analysts said that the fact that Suzuki did not use the word concerned then suggested intervention in the currency market may not be imminent. Intervention could be possible technically, but it's difficult politically to sell the dollar at a time when the U.S. is tightening inflation. Now, what they're referencing here is the Bank of Japan selling its dollar reserves, because the Bank of Japan actually holds the most dollar reserves, treasuries, than any other country. I think China is second at around like 980 billion, but Japan holds like $1.2 trillion worth of U.S. debt in treasuries. And if the yen is dropping dramatically, especially against the dollar, what the Bank of Japan can do is sell their dollar reserves, their $1.2 trillion worth. They can start to sell those, eat into them to buy yen. So they sell treasuries, sell dollars to buy yen, which kind of helps balance out that exchange rate. But what they're saying here is that it's not really politically viable, just because it would put a lot more pressure on the dollar amid the inflation. And the last thing Japan wants to do is really piss off the US, or because they're very connected, and that could encourage them to drive interest rates higher, which would hurt Japan. And so everything's interconnected. They don't want to step on the US's toes, even though they really probably do need to sell the dollar to buy yen to hold it up a little bit, because I don't know how much longer they can withstand such a massive depreciation. But I digress. So last little bit, Japan last intervened by selling the dollar and buying the yen in foreign exchange markets in June 1998. So it's been well over 2 decades since they've last done something like this. And that was when the yen fell beyond 146 to the US currency. And like I mentioned, it got to 145. So in the beginning of this, this is a couple days ago, they were saying the yen, I think it was, so weakened beyond 141. Since then, it's already gotten to 145. And the last time they dug into their reserves to bolster the yen was when it got to 146. So we're basically there. Again, I don't know if they're going to do anything. The environment is obviously very different. Politically, it's kind of complicated. But something's going to happen. Either the yen is going to keep going, maybe to 150, 160, who knows, or something's going to have to change. Something's going to have to break in the global economy, whether that's the Bank of Japan itself, because yields getting out of control, and them getting into like some debt spiral because they can't afford the interest payments, or maybe something in the US or some other country breaks, and then everyone, all the central banks kind of collectively come together and say, okay, we're going back to easing. I don't know, but this is a huge story that people really need to watch, because this is a major country and the third most important currency that is just absolutely spiraling out of control. But anyway, stay positive, guys. So next story. All right, so our next story is India. The Indian central bank governor says he aims to prevent rupee depreciation. So like a lot of currencies, they've been depreciating pretty rapidly against the dollar, and the Indian rupee was no exception. So the Indian central bank aims to anchor expectations. Like I said, this is a real theme. They're really showing their true colors here about how their sole goal is to manage everybody's expectations. So the bank aims to anchor expectations around the depreciating rupee and will intervene to prevent an overshoot, ensuring the exchange rate reflects fundamentals. India Governor, here's another one. Okay, so Shaktikanta Das said on Monday. That wasn't bad. Thank you. So the partially convertible rupee has so far depreciated more than 7% against the US dollar. Nothing compared to the 25% of the JPY or the yen, but still noticeable or significant. Our intervention policy is to prevent excessive volatility in exchange rates, to anchor expectations around depreciation. Many economists have said that the rupee was likely to struggle against the dollar as slowing global growth and the U.S. Federal Reserve's interest rate stance overshadowed the RBI's interventions. Das, however, expressed confidence that foreign exchange reserves of $561 billion as of August 26 provided a cushion against external shocks. So this is getting back to kind of the thing I was talking about with Japan and them protecting the yen. India doesn't have nearly as many reserves. I mean, 561 billion is still a huge amount, but nothing compared to the 1.2 trillion that Japan has. But still, a sizable cushion nonetheless for them to, the term often used is protect their currency or defend a certain minimum exchange rate. So if the rupee falls to whatever level, they will start to sell some of those $561 billion in reserves to maintain whatever level that is. But you have to keep in mind, they are not the US. They don't have a money printer. They only have $561 billion in reserves. So they can only defend an exchange rate or some type of peg for so long, basically until they eat away at the bulk or all of those reserves. So it's something to keep in mind, especially if you start seeing that number, 561 billion, really start to decline meaningfully. At a certain point, they may have to just cave and let the rupee depreciate dramatically against the dollar. It's kind of like when George Soros broke the Bank of England, when the peg to the Bank of England, they had their currency pegged to the Deutschmark, and they didn't have enough reserves to defend it, and George Soros made $1 billion. But anyway, that's a little aside, a little tangent. So the fall in global crude and other commodity prices, coupled with the return of foreign investors to the Indian stock and debt markets, have eased pressure on the Indian currency. Inflows of foreign funds in August alone touched $7.5 billion, much higher than the net inflows in the previous month. Going forward, our monetary policy will remain watchful, nimble-footed, and calibrated in order to ensure price stability while supporting growth. It's a pretty nothing burger statement, but so I guess the moral of the story to take away from this is that their currency is struggling a little bit, at least relative to the dollar, and they are willing to defend that exchange rate to reflect fundamentals.
Right.
That's what they always say, though. But anyway, important to watch. Currencies are exciting these days. Trust me.
Totally.
All right, next story. All right, so we are going to transition to commodities now. Woo! So starting with the Kremlin warns the West of retaliation over G7 oil price cap. So I talked about this before. The G7 countries, which is just the largest 7 countries in the world, the most powerful, they have been trying to come together to collectively implement this price cap on Russian oil. And for those who are familiar with economics, putting a price cap on a fungible commodity doesn't really make sense.
You're a fucking idiot.
You can buy oil. I mean, what people do, as an example, Saudi Arabia will buy oil from Russia and use that themselves to, run their economy, and then they will sell their oil to someone like the US and basically arbitrage that difference. So they buy it for cheaper from Russia and sell it at the market price, which is higher, to places like the United States. And even if they were going to sell, they just took Russian oil and were going to sell it to anyone, how would you know? It's the whole point of it being fungible. You can't tell. I've heard some people talk about how the certain Russian oil has various sulfur qualities to it that you can identify. But I've also heard that some of the refiners or the distributors, they will just mix, blend different oils to where you can't really discern the exact sulfur level that is, you can discern the sulfur level, but it kind of hides that it was from Russia because you mix it with other oils. And so realistically, you can't stop it. Like, as long as people are able to get access to the Russian oil, you're not going to know if it's Russian oil. And so, in my view, this is kind of a really stupid thing. But Russia doesn't like it, as you can imagine. And so they are, I'll just read this. So the Kremlin warned the West on Monday that it would retaliate over a G7 proposal to impose a cap on the price of Russian oil. There can only be retaliatory measures, Kremlin spokesperson Dmitry Peskov told reporters. So Peskov said last week that Russia was studying how a price ceiling on its oil exports would affect its economy and warned the move would destabilize the global oil market. It really would, though. So a senior economic advisor to Ukrainian President Zelensky welcomed the development and told Reuters the cap was needed to curb Moscow's revenues. Look, obviously Zelensky wants to hurt Russia as much as he can, understandably so, totally get it, but I don't think he understands how economics really work, or how the energy market, the oil market functions, and how you can't really cap a fungible commodity. It's not exactly easy to, focus in on what oil is Russian, and obviously this is going to lead to massive inflation. I mean, when you have such an inelastic market like oil, a 5 or 10% decline in oil just because you're implementing some price cap on Russian oil is going to have a serious impact on price. So it's, probably just going to bite the Western world, or those imposing the sanctions, in the ass. And also you have countries like India who are basically saying, no, we're going to keep buying Russian oil because we have a duty to, to our consumers, our constituents. I believe I was actually just watching a video earlier of the Indian, I think it's petroleum minister. I think that's the title. And he was saying, like, yeah, they're going to buy oil from Russia because he has a duty to his consumers, to the Indian people, to, keep the lights on, essentially, and make sure there aren't energy shortages, which, look, is, people like to view the world as black and white, but it's not always like that. There's a lot of gray areas, and it's hard to say, like, do you not accept the Russian oil and let your people suffer, or do you kind of get on board with these Western sanctions? There isn't really an obvious answer, and so, it's really tough to say. But yeah, anyway, so last little bit. Before Russia sent tens of thousands of troops into Ukraine in February, around half of Russia's crude and petroleum product exports went to Europe. So that has since obviously changed. But I mean, when you are talking about half of your energy, or not just energy, I mean, they're getting more than that from Russia, and if you include natural gas, but from petroleum product exports, half of those to Europe being cut off because of sanctions. I mean, I can't even comprehend the implications that has for an economy. All right, a lot of happy stories today, guys. So let's transition to one more. What do we got here? So yeah, another very happy story. GAZPROM officially shut off Nord Stream 1 pipeline. They've been reducing this stream to, incrementally over time, and prior to this I think it was at 20%, and they just cut it off. So Russian gas giant GAZPROM, which is basically the state-owned, state-controlled energy company in Russia, said on Monday it had received a formal warning from Russian regulators that the idled Portovaya compressor station, which is supposed to push gas towards Germany through the Nord Stream 1 pipeline, no longer complied with safety requirements.
Right.
Gotta love how they throw this stuff out there. Safety requirements. So GAZPROM had said on Friday that it had detected a leak of engine oil in the only turbine that was still working at the Portovaya, and would shut off natural gas supply until it was repaired. On Monday, it cited Siemens Energy, that's not a joke, that's really what their name is, which has done maintenance on Nord Stream 1 turbines, as saying that the causes of oil leakage can only be eliminated by a specialized repair company. It's
Totally.
it's so funny. You gotta admire their candor, right? So Siemens Energy said on Saturday that it had not been commissioned to carry out the work, and that the leak reported by GAZPROM would not usually affect the operation of a turbine and could be sealed on site. So basically saying what we all kind of know, read between the lines. Obviously, this is, they're shutting down Nord Stream 1 because they want to hurt Europe, not because there's some leak or whatever it is. Even if there is, I'm sure, based off of this statement right here, it would not usually affect the operation of a turbine and could be sealed on site. So even if there is a problem, they're exaggerating the complications it poses. So, but like I said, like we didn't already know that. We know that the real reason they're doing this is because they want to hurt Europe, and they're just coming up with some reason so they have like plausible deniability.
Right.
So Kremlin spokesman Dmitry Peskov on Monday reiterated Moscow's position that the problems with the supply of gas from Russia were entirely the result of Western sanctions.
Little bitch.
Yeah, totally. Anyway, so next story. All right, so this is kind of a big deal. So oil producer, or OPEC Plus, I don't know why they say oil producer group, it's kind of annoying. So OPEC Plus surprises energy markets with a small production cut. So the previous months, they decided to up the production by 100,000 barrels, and this next month they are basically reducing it by that same amount. So they raised it for like a month, and then they're going back to what their normal, or I guess maybe not normal, but what their original, like a few months ago, output was expected to be. So a group of some of the world's most powerful oil producers on Monday agreed on a small output cut from the next month, surprising energy markets at a time of considerable turmoil. OPEC and non-OPEC partners, an influential energy alliance known as OPEC Plus, decided to cut production targets by about 100,000 barrels per day from October. Last month, OPEC Plus agreed to raise oil outputs by just 100,000 barrels per day. The minuscule boost was widely interpreted as a rebuff to U.S. President Joe Biden after his visit to Saudi Arabia. So they gave Biden a month of 100,000 barrels, which is really nothing, absolutely nothing in the grand scheme of things. So OPEC Plus said in a statement that Monday's decision to revert back to August levels of production was because the upward adjustment was intended only for the month of September.
Totally.
And the next OPEC Plus meeting is scheduled for October 5th. So I guess keep that date booked in case you want to, see if they're going to change their stance. It seems that OPEC is really they want oil to stay high. They are, oil prices, and historically speaking, are still extremely high. So them cutting production is kind of obviously they have their own self-interested reasons to do that, but I've heard multiple stories where they're talking about they want, again, read between the lines, they want to keep oil high, maybe like $90 or higher. And right now, oil has actually been tumbling. I think it's like a low 80s. So definitely not getting what they want, but they do control a large amount of the oil market. So maybe on October 5th, they come together and they say they're going to cut even more, which could easily drive oil back to the $90, $100 region. But obviously, who knows? Not financial advice. All right, yeah, so more of the story, OPEC is cutting energy production by 100,000 barrels. Not anything crazy, considering they just raised it by 100,000 barrels the previous month, just going back to kind of like their normalized production output. But still, just kind of a little bit of a slap in the face to the Western world, and Biden saying like, oh, you came over here to, kiss the, MBS's ring and beg for more oil. We'll give you 100,000 barrels 1 month, and then...
And we say bye-bye!
Yeah, all right, so transitioning to crypto now. So this is kind of a big story. So Binance pulled support of USDC and is converting a bunch of other stablecoins as well into BUSD, which is the Binance stablecoin. So Binance, the world's largest cryptocurrency exchange by volume, announced today that it would begin auto-converting existing and new deposits of USDC, USDP, and TUSD stablecoins into its native BUSD, effectively delisting 3 rival stablecoins.
Not crazy.
So notice that USDT Tether is not included in this, and I would have to imagine that's because of its prevalence in Asia, which Binance is largely operating in, because there's a lot. USDC is the second most popular, but it's largely the reason it's that popular is largely because of the Western world, like the US adopting it so aggressively. But when you're talking about the Asian countries, they almost exclusively use USDT. So I would imagine getting rid of that on Binance would be extremely unpopular. So that could be part of the reason why they're not including it. Still, they may add it in the future. But as of right now, USDC is the big one. I don't know how many people use these other ones, but if you ask me, it's it's USDC and USDT. I guess BUSD now. So among stablecoins, USDC is the second largest by market cap at $51 billion. Binance's BUSD stablecoin is a distant third with a market cap of $19 billion, less than half that of USDC.
Little bitch.
This will not affect users' choice of withdrawal. Users will continue to be able to withdraw funds in USDC, USDP, and TUSD at a 1-to-1 ratio to their BUSD denominated account balance. The change is set to take effect on September 29th. Additional changes announced by the company include the removal of support for USDC, USDP, and TUSD products, including spot trading, futures, and margin lending. The largest stablecoin, Tether, has a market cap of $67 billion and will remain accessible on Binance.
My man!
Yeah, so big deal. I mean, delisting the second largest stablecoin, I mean, that's pretty monumental considering how many people probably use it. But yeah, exerting some of their monopoly power, right? They can get away with it, so why not, right? Although, if you ask me, kind of funny how this pretty obviously runs counter to the whole decentralized narrative. I mean, you have this centralized company forcing you into using their centralized stablecoin. Kind of silly.
For real? You fuck with that?
All right, next story. So this is kind of a big deal. So the top Bitcoin mining pool froze withdrawals. It was Pooler is the name. It is one of the largest Bitcoin mining pools. I think it's responsible for about 10% of the total hash rate, and it suspended withdrawals. So we've heard this a lot with a lot of lending platforms, but this is the first mining pool to halt withdrawals. Kind of a big deal. Okay, so Bitcoiners are concerned after Poolin, a Beijing-based Bitcoin mining pool that's responsible for 10% of the overall Bitcoin network hash rate, announced a freeze on user withdrawals on Monday. Mining pools are, this is a little, for anyone who doesn't know, I'll just cover this. So mining pools are groups of miners that unite their efforts around one network node to mine as much Bitcoin as possible. The miners then share the spoils, but only if the pool operator has the will and means to distribute them. So what they're basically talking about here is from Bitcoin mining, it can be pretty expensive to get all the mining rigs. And even if you get all that, realistically, it's impossible for you to win a block just because there's so many other players with such a large amount of hash rates that the odds just are incredibly stacked against incredibly stacked against you. So it'd be like trying to win the lottery, essentially. But if you take all these like individual mining operations, like if it's just a single person or like a small group, and you join a mining pool to pool your hash together, then you dramatically increase your chance because maybe collectively you get to like 10% of the total hash rate or whatever it is, which means you would expect to win blocks roughly 10% of the time. So by pooling, you as a smaller mining operation or individual miner, you can actually reap the benefits of mining because basically when they win a block reward, they divvy it up to all the people that are a part of it, pooling their hash according to the amount of hash rate they're contributing. So if one person contributes like 1%, they get 1% of the profits. If another one contributes like just a basis point, then they get a basis point of the profit. So just kind of it's a way for I guess anyone who's not part of a huge large scale mining operation to take part in mining and actually get a reward.
Totally.
So Poolin said it was facing some liquidity issues due to rising demand for withdrawals and announced a number of measures in order to stabilize its operations. These included pausing withdrawals from its pool account and temporarily suspending its Bitcoin and ETH bounce payouts. To compensate, Poolin has now introduced a zero-fee offer to all of its Bitcoin and ETH miners, alongside other coins that may take ETH hash rate after its transition to proof of stake. So a lot of mining operations or mining pools, they take a fee basically for like organizing the whole thing. They'll try. I don't know what the fee is or what like a representative rate is. I'm not really sure, but they will take a fee, for organizing the whole thing. And so right now, I guess to appease some of these angry participants, they are reducing that fee to 0, which is nice. I've actually heard a lot of people talk about in the long term, fees are going to go negative because people are going to want to encourage people to join their mining pool. But that's another story for another day. So the offer lasts from September 8th to December 7th for normal users, but can extend to 1 year for clients holding over 1 Bitcoin or 5 ETH in their pool accounts. So Poolin announced yesterday, I believe, that it was deactivating its pool account and Poolin wallet as payout withdrawal options for miners. The The pool account now only supports the withdrawal and storage of current assets.
Not crazy.
Yeah, so that's a big deal. I mean, this is one of the biggest mining operations, mining pools, and they are suspending withdrawals because of liquidity concerns. Now, I don't know if this is going to be a problem for other miners, but this is definitely an important story to watch because, I mean, I don't really know what this is, what implications would follow from this, if this is going to lead to some, meaningful issue with Bitcoin, but still, pretty crazy story. And like I mentioned in the beginning, it's the first pool showing liquidity issues because we've seen it without these lending platforms. So, starting to see this extend to other regions of the crypto market. All right, final story. So, a lot of people in the crypto world are excited because the ETH MERGE is coming this either this week or next week, I believe. I think they have a soft date of like September 19th. But I'm just going to go over what exactly is happening, just a brief overview, nothing crazy. I'm not going to get super technical, not that I could.
You're a fucking idiot.
So the merge is, for those who don't know, just switching from proof of stake to proof of work. Proof of work to proof of stake. So soon the current Ethereum mainnet will merge with the Beacon chain, which is their proof of stake system that is running parallel to the current chain. So they've been running this as like kind of a test net, basically, in like a parallel chain to the current one, or the like mainstream one, the main net that like everybody's pretty much using. And this is, how they do it. They test it out just to see if they'll get all the bugs out and work it out. And people were already staking on the Beacon chain and all this stuff. So basically they're going to merge the chains now. This chain that's been running parallel, the Beacon chain that was operating under proof of stake. So this will mark the end of proof of work on Ethereum and the full transition to proof of stake. This sets the stage for future scaling upgrades, including sharding. Not what you think. So the merge will reduce Ethereum's energy consumption by 99.95%. Oops. So it's important to remember that initially, the Beacon chain shipped separately from mainnet. Ethereum mainnet, with all its accounts, balances, smart contracts, and blockchain state, continues to be secured by proof of work, even while the Beacon chain runs in parallel using proof of stake. The approaching merge is when these two systems finally come together and proof of work is replaced permanently by proof of stake.
My man!
So the merge represents the official switch to using the Beacon chain, that parallel chain, as the engine of block production. Mining will no longer be the means of producing valid blocks. Instead, the proof of stake validators assume this role and will be responsible for processing the validity of all transactions and proposing blocks. And actually, because of this, at least I can only assume it's because of this, Ethereum Classic has had a major uptick in both price and hash rate. And you have to imagine that's because a lot of the Ethereum miners being basically, forced out of Ethereum in this transition to proof of stake. So they're going to other proof of work networks like Ethereum Classic. So I believe I saw a story like that. So just a little aside. So in this transition to proof of stake and the Beacon chain, no history is lost. As mainnets get merged with the Beacon chain, it will also merge the entire transactional history of Ethereum.
Nice.
Despite swapping out proof of work, the entire history of Ethereum since Genesis remains intact and unaltered after the transition to proof of stake. Any funds held in your wallet before the merge will be accessible after the merge. No action is required to upgrade on your part, unless you're like a client or something. But if you're just a regular user, you don't have to do anything.
Yep.
So the client developers are currently working to a soft deadline of the 19th of September. So I think originally they had a range. It's like September 10th to 20th. So, it could be the 19th. They're always up in the air. I mean, this has been planned for like 8 years. So any date is going to be tentative at best. But plan for, I guess, the 19th. Okay, and the last thing I want to touch on for this merge is they have a helpful little misconception section. So just things that people maybe think is going to happen and then correcting it and, basically telling people that, here's an example. So the merge will reduce gas fees. False. The merge is a change of consensus mechanism, not an expansion of network capacity, and will not result in lower gas fees. Yeah, it kind of sucks. That's kind of like the whole problem, right? So, and then another misconception. Transactions will be noticeably faster after the merge. False. Though some slight changes exist, transaction speed will mostly remain the same on layer 1. Now, I think one of the benefits of this transition is that it opens up the door for like better layer 2s. Or actually, it's the sharding, which is kind of like, for anyone familiar with Matic, I believe that is kind of a version of sharding. It's basically like a scaling protocol. And sharding is kind of like what the Lightning Network does, where you basically have all these transactions that take place off the main, like the main chain, not the main chain, but like it's, so like for Bitcoin, every transaction is kind of on the chain, right? Every block, basically. But with the Lightning Network, you have all these transactions that take place off the outside of that main block, and then you get a final tally basically, and that gets added to the block. So you get like one number instead of like 100 of these little transactions, and then that gets cemented into the like the main blockchain, and that's kind of what sharding does. And so that's going to be one of the main like I guess benefits of this. It's not being added yet, but it's kind of opening the door for Ethereum to start sharding. That sounds so stupid. So another misconception: you can withdraw staked ETH once the merge occurs. False. Staking withdrawals are not yet enabled with the merge. The following Shanghai upgrade will enable staking withdrawals. And then another misconception: when withdrawals are enabled, stakers will all exit at once. A lot of people have been saying as soon as the proof of stake is officially live, that all these people that were staking are going to just withdraw their staked ETH because it's been locked up for so long. And they're saying false. Validator excerpts are rate limited for security reasons. I don't know what that rate is, but I don't know. I'm sure when it goes live, there will be some people withdrawing their ETH just because it has been locked up for so long for a lot of people. But I guess they say there's rate limited for security reasons, obviously, because you don't want everybody just taking all their ETH and running. But yeah, interesting. I actually didn't know that before reading this. And then final misconception: the merge will result in downtime of the chain. False. The merge upgrade is designed to transition to proof of stake with zero downtime. So for most people, they won't notice anything. Nothing will really change. This mostly just affects like miners and I guess clients or validators, people kind of running it. But for the most part, for like the average person, you won't notice anything. It'll be at least hopefully a seamless transition to proof of stake. All right, well, that is all I have for this week, but let me go ahead and go through some of the stuff we got coming up next week. All right, so tomorrow we have the ECB delivering its interest rate decision, with the expectation, like I said earlier, being a 75 basis point hike, bringing its rate to 1.25%. I believe the target range was like 0 to 50 basis points, so a move to 1.25. And mind you, that is in the face of 9% inflation.
You're a fucking idiot.
And then on Thursday, we get the initial jobless claims in the U.S., a speech by Chair Powell, and China inflation and PPI numbers. The previous U.S. initial jobless claims was 232K, and the forecast is a decrease to 230,000. And then China's inflation is expected to increase to 2.9% from 2.7%, and its PPI numbers for August are expected to decline to 3.1% from 4.2%. And then on Friday, we have Russian GDP and inflation numbers coming out. GDP is expected to decline by 4% versus the previous year of positive 3.5%. And its inflation for August is expected to fall to 14.2% from 15.1%.
God damn!
Yeah, pretty big number. So, and then also on Friday, we have Fed Waller giving a speech, not as important as Powell or Brainard, let's be honest, but a Fed chair nonetheless.
Totally.
And then next Monday, we get German inflation numbers. 7.5% was the previous month, and then 7.9% is the forecast. And then we also have UK unemployment rate coming out. The previous was 3.8%, and I don't believe they had a forecast, unfortunately. And then finally, next Tuesday, we get US and UK inflation numbers for August. That is obviously going to be a very important report or number to watch, the US in particular. Sorry, UK.
Little bitch.
But obviously, the US inflation numbers these days are the most watched and anticipated thing. So definitely watch that next Tuesday. But that is all I have for you today. Aww. So on that note, stay happy, humble, and most importantly, solvent. And I'll catch you all next week.
And we say bye-bye.